So good day. Appreciate you tuning in. Patrick Torgrimson, Premier Real Estate Services. It is May 12th, 2022, and doing a little midweek wrap up of what's been going on since last week into today. And there's a lot of things to talk about actually, and I'm not going to do it all in this video because I want to do a three-part video series talking about what I see happening in the future within the housing market. And with addressing the housing market, I can't do that without talking about the 10-year Treasury, and I can't do that without talking about what the Fed is decidingly going to do or what they say they're going to do. And so I think these topics are personally important, not just whether or not you're thinking about buying or selling, but because the information that I'm giving isn't necessarily out on mainstream news. And I think it, and I hope it'll help you make some long-term plans, as long as we can make them anyway. Long-term isn't long-term anymore, but to make some good decisions based on what I see moving forward here. And so anyway, I want to do a three-part series, hopefully finish that up in the next week and a half, and get that out as well. But first off, what I want to talk about is the U.S. 10-year Treasury. Now, keep in mind, last week, I missed the update, but midweek last week, this was trading at about 3.13%. And as you can see in the graph, is dropping. I'm not going to say precipitously by any means, but it is dropping. And I said a while ago, a couple months ago, that you're going to see some volatility in this market, as well as you're going to see volatility in the stock market. They are connected. In fact, a guy I listen to quite regularly made a very succinct point the other day in saying that the stock market is just a derivative. The stock market, the Dow Jones overall is a derivative. And it's a derivative of what you're looking at. It's a derivative of the debt market overall. And I've said this in past videos, what you want to pay attention to is the DXY, the dollar strength. You want to pay attention to the 10-year and 2-year in relation to each other and whether or not they invert and all this stuff. But also, you want to pay attention to the Fed and their decisions to maneuver this economy. And so as we're watching this decline, we had Fed basically saying yesterday they're going to move forward with continued rate hikes. And what in my world, now keep in mind, folks, that last year at this time, interest rates were hovering around, I mean, you could get a conventional 30-year between 2.5% to 2.8%. Well, now they're at 5.5%. That's a 3-point swing in a year. And we're already seeing the lower, the market movers, the ones that instigate this whole thing from beginning, is the first-time home buyers. We're seeing some of them drop off. And why is that? Well, if you take a $200,000 house, and keep in mind an interest rate is at 3% is $3 per every $1,000 you spend. So an interest rate at 5.5% is $5.50 for every $1,000 you spend. So multiply that out. You know, a $200,000 house at a 3% interest rate, you're looking at what? $600 a month just on interest. Okay, that's not principal and taxes, insurance, which most people probably escrow. But you bump that up by another 3 basis points and are paying 6% on interest. So now what are you up to? Well, you're up to $600 per every 1,000. So for a $200,000 house, it's $1,200 a month. Well, here we are again. We're fighting it. We're trying to fight inflation. Well, supposedly we're fighting inflation. I don't see them doing anything about that, because you can't raise this rate high enough to actually fight inflation. Once you do, you're going to have downward pressure on house prices. Now, the one thing that can keep that stable is, of course, if there's no inventory. If no one's going to sell, and why would they? A lot of people locked in at 2.5%, either by purchasing or refinancing. Then you have housing construction costs being what they are. I mentioned this in another video. I mean, I do. What the probability is, I don't know, but I do foresee a future where it is possible that we enter into a somewhat stagnant market where no one's moving. And if the first-time home buyers can't afford to get into a property, then who's going to drive this market? So the Fed is going to try to manipulate this along. And I heard from the Dallas chair yesterday, I believe he's from the Dallas Fed, saying that it's showing signs of a bubble in the housing market. Well, of course it is, because they're driving it. And what they do with that and how they drive that moving forward is going to be, like I said before, I will throw the yellow cautionary flag when interest rates hit 3%. They did. I said we're heading into territory that's going to destabilize the Fed, and so to speak. Now they've receded. They've come down, of course, because they can't hit a certain threshold without stopping absolutely everything. And we're going to monitor this moving forward, guys. This is an important piece of information. It's kind of like 2 + 2 = 4 in my world. It doesn't in the government world sometimes, but it does in most of our worlds. The next chart I'm going to show you here, and check this out. You're looking at the US dollar index, the DXY for short. This is one of the things I say pay attention to. And what this is it's the relative strength of the dollar versus a basket of currencies. So the euro, the yen, those currencies that are traded on the markets, and are semi-major players, if you will. This is what this is based off of. Now, here's a fun little exercise. Don't Google. I don't know if Google it if you want to, but there's other search engines to use. But Google inflation riots around the world and set the timeline to this past year. You'll see what is happening. The fact that our dollar is trading at almost 105, we're talking 2-decade highs of the strength of the relative dollar. Now, what that does is if you travel overseas, your dollar goes further, right? It also supposedly is supposed to make imports cheaper. Well, are they? And are you seeing that? Obviously, we're fighting inflation because you can see it at the pump. The housing bubble, I guess, if you want to call it. I'm not so sure I would say that just because they're inflating it themselves. But the housing issues, both rent and single-family homes, but grocery stores and all of this stuff, all of this plays into the monthly budget of people. So if you have rising interest rates, rising oil, and rising grocery prices and everything else, something has to take a hit somewhere. And so the fact that this is trading at a near 2-decade high, well, I think it's actually over a 2-decade high now, and still we have persistent problems of high products. It's telling you that the whole world over is experiencing this problem. And all it is a relative strength. It could be $204.50, and it still wouldn't matter because it's telling you, and I showed a chart from this before, how much M2, how much money there is in the markets and how much they printed over the last few years. All the central bankers around the world have done this. And so the fact that we're the shiniest, in the punch bowl, it doesn't really matter when the reality of what we're doing and what we're seeing in the marketplace is playing out the way that it is. The fact that it's highest isn't surprising because we still have a printing press and we're still the reserve currency of the world. But it's something to keep an eye on nonetheless. But this absolutely should be deflation positive. It should work in our favor, but as you're seeing, obviously it's not because the prices aren't coming down as much as everything, as much as the dollar's going up relative, right? So I'm gonna save a lot of this stuff and talk about it more in depth in this 3-part video series I want to put out. But I'm just going to leave it at this: the market right now, the housing market, is definitely showing signs of, I'm not going to say weakening, but leveling off. I personally would love to see a more balanced market. There are houses that are on the market right now. I know that buyers have dropped off, and whether they sign new leases or just were priced out of the market, we'll see. But those first-time buyers are what drive everything. And if they're not there, I mean, what does everybody think that's going to happen? I mean, something, like I said, has to give along the way. And so moving forward over the next month or so to see what the Fed actually does with the interest rates and to see where the 10-year Treasury goes in relation to that is going to be very interesting. Can we see a leveling off of home prices, or is it going to be something like 2008? I'll address that later on in a video, but until then, I appreciate you tuning in. Like I said, if you guys enjoy this stuff and haven't subscribed, subscribe, share, message me, do all those things, share it with other friends that you might, that they might find it useful. And until then, appreciate you tuning in, and we'll talk soon.